let's start with SpaceX IPO'd recently. What have you been hearing amongst your people? I mean, we've talked a lot about what we thought might happen, and there was going to be a lot of cash that people were going to make or be able to tap into, and that opportunity zones should be something in the conversation as people consider diversifying and reducing tax on the money that they make from being a part of any of these IPOs that are coming.
Yeah, so the IPO happened. It went well. The stock went up for a few days in a row. It's down now below the IPO value, but still a high cap for the stock. The interesting thing is the reason it falling below the IPO value is I've seen some releases on individual lockouts for when people can sell. And there was a early release of locked out shares, if I believe the property, or if I believe if the stock closed greater than the IPO value for 7 out of 10 consecutive days or something like that. And it doesn't look like right now it's going to meet that threshold. But I also think the large, so I think that ultimately we're going to see a lot of people, as we were talking about last time, become, millionaires, even some billionaires, including my favorite part, the welders, the cafeteria staff, and others that are going to end up getting life-changing money. And I think our goal is to kind of give you some insights and advice on how to minimize your tax burden and maximize the actual amount that you get to put into your pocket or your family gets to benefit from, such a life change.
Yeah, it's been interesting over the last couple of weeks talking to a lot of different wealth managers, family office, especially in Southern California. It seems like everybody's got a client. I saw a photo today that said the license plate on the new Tesla was SpaceX paid. There's that as a use of the the proceeds and all the hard work, and then there's other options. And one of the ones that we found for whether it was business owners when they sell their business or anytime somebody has a big capital gain event, opportunity zones, and the legislation from the Tax Cuts and Job Act in 2017 and now the big beautiful bill of last year has created a tax advantaged real estate investment opportunity where clients can get really great returns, use some of the tax benefits and advantages effectively, and get high quality real estate that they control that has a long-term income stream and can really buy in some great locations that, based on the 2010 census, have really changed and become great spots to invest in. That maybe 16 years ago they met the qualification of an opportunity zone, but today are much nicer than they should be. Jason, maybe for a second, talk a little bit about some of the OZ benefits. I mean, you and I got to know each other through work you were doing as soon as opportunities came out or opportunity zones came out and you started to understand all the different tax benefits. Go into a little of that for who's watching today.
Sure. So, and currently for folks that are going to be in Opportunity Zone 1.0, which ends at the end of this year, the main benefit is you invest your capital gains dollars and then you can use depreciation tax free, or I guess recapture free, to offset a bunch of that gain while still getting a quality asset that passively cash flows. Now, I think most people do the lockouts. And if I was advising, I would say hold your shares and sell them next year and then take your gain into Opportunity Zone 2.0, because there'll be benefits such as a 5-year deferral on the payment of your taxes, 10% reduction in the actual capital gain amount. So it lowers your tax bill by 10. And then you get, obviously, with the 5-year deferral and inflation, you're essentially paying your tax bill with substantially inflated tax or dollars comparatively to the time that if you were to pay when you bought it. I think, Justin, too, I think one of the things that's most interesting, maybe you guys talk about it as you're looking at the zones with your team, is the rural areas. Cause I think the rural areas are really fascinating. And I thought about you the other day because we have a client that owns of the firms that owns a big ranch in Southeast New Mexico near the Permian Basin. And they're looking at opportunities. They have, some of the ranch already has, besides the cattle that they farm, they have solar and wind farms on it. And there's large companies that you would know of that are interested in putting data centers on their property because the solar and wind will generate enough power where it doesn't need to be part of the grid. The natural gas pipelines run through the ranch already. So guys want to talk a little bit about what you guys might see as opportunities in the rural areas?
Yeah, absolutely. I think as we get into Opportunity Zones 2.0, the rural areas and then rural areas that won't be rural areas in 20 or 30 years are, I think, some great spots in the opportunity zones. But Jason, you had talked a little bit about like where somebody has some tax benefits. I'll quickly run through a numbers example for someone. For example, for one of our clients that invests in what we call these golden opportunity zones, where you get long-term credit tenant on a double net lease that's very passive for the owner and you get some stable cash flow. We do a lot of Chipotles, we do Starbucks. For example, we also have done a number of 7-Elevens, but a variety of different national brands that are publicly traded as the guarantee on these leases. Here's what the numbers might look like for somebody who has $1 million capital gain from the sale of their stock that is IPO'd and what that looks like. So, $1 million investment in a Starbucks or a Chipotle buys a property worth about $2.5 million. And what somebody's going to get is between 35 and about $50,000 a year in annual cash flow. And I'm going to go through all the different numbers and benefits and give you the total return in a second. But those first 5 years, you make $175,000 in cash flow. The second 5 years of the 15-year lease, you're going to make $250,000 in cash flow. So that's $425,000 in cash flow you make over the 10 years of the investment. You factor in that you're going to get $250,000 in principal reduction over the 10-year hold period that the opportunity zone requires. Because the rent will increase 10% at year 5 and 10% at year 10, you're going to have somewhere around a $500,000 appreciation in the property. Now, as Jason mentioned, you pay no capital gains tax on that appreciation. And then effectively using cost segregation or buying a bonus depreciation property, the other benefit he mentioned was that there's no depreciation recapture. So if an investor uses $1 million worth of depreciation to either offset their gain or to offset their cash flow over the 10 years, that's another $250,000 in taxes that you wouldn't have to pay. When you add up the 250,000 in depreciation that you don't have to pay, the 500,000 in appreciation, the 500 or excuse me, the 450,000 in cash flow and the $250,000 in principal reduction, you get about a 14% annualized return on one of these investments that has, again, the credit tenant, not a lot to do, if anything, and a bunch of tax benefits and a much greater return than you can get from buying a bunch of bonds.
I mean, I think that that's fascinating. 14% annualized return would be considered a solid return on most stabilized real estate deals that we do. We have a lot of clients that are really happy, that would be really happy with that. And, in this case, it combines a lot of tax benefits as well. So I think that's a really fascinating opportunity. And, Justin, we talked for a second about some of the rural areas here, and it might not be about the farm itself, or the ranch is not in the OZ, but the main town closest to the ranch is in OZ. So they're going to need people to have a place to live when they're working at these big places. And there's not enough current infrastructure in the towns per se to support all the workers for not only building the facilities, but maintaining and operating it on a daily basis. So there's opportunities to look at, new commercial retail centers or apartment complexes or other things in those towns that are close to those developments. And, we've seen a lot of opportunity that your team has found in things that are adjacent to places you want to own real estate, right? Like I think of the Burger King we did in Indiana, which was across the street from the entrance to a major university with 15 or 20,000 students. We find, you guys find these opportunities where, it's a development that's going on over here, and we're right next door where everybody, I mean, I think of the Murfreesboro 7-Eleven gas station that was at the edge of Murfreesboro, but where everything was being built in a brand new shopping center with a Publix and a big, I think it was HCA medical office building. So I think that's part of the other opportunity here to look at as well.
Yeah, and going, you were mentioning the rural zones, and one of the things as we talk about big differences in OZ 1.0 and OZ 2.0 is that there will be these rural designations now, and if somebody invests in what was a rural area, this Jason talking near this ranch that's going to need people, that the 5-year deferral is not 10% like it was in OZ 1.0 for everything. But if it's in a rural designation, the tax gets reduced by 30% after 5 years. That's a long time to be able to use the government's money to make your own money and then have a tax reduction as well by finding these right sites in rural OZs.
30% is a huge number. That's why I keep mentioning it, is because it's like, it's an interesting opportunity. That might be what one of the new golden OZs, right? Is finding good opportunities in rural zones, not just zones that shouldn't necessarily be included. So
Absolutely. I think it's going to be a neat part of OZ 2.0 for our investors that have realized gain in 27 is finding those right opportunities. One of the things that opportunity zone investing also allows for somebody that has had a ton of benefit from one of these IPOs is the ability to have real estate professional tax status. If you own OZs and you're actively managing your opportunity zone property, it makes it far easier to qualify for that. And there's tremendous benefits, not just on the properties that are owned, but across somebody's investment portfolio and how they make money. Jason, when you get a chance there, maybe give us a little bit of insight on what real estate professional status means, how somebody acquires it, and what are some of the benefits that by owning an opportunity zone property, they'd be able to realize not only on their opportunity zone property, but on other parts of their investment portfolio.
sure. So there, start first with, there's a common misconception that to be a real estate professional, you have to be a licensed broker or agent. That is not the case. So there's a three-part test. It has to do first with the hours invested. So you have to invest at least 750 hours a year into real estate investment management, searching for your deals, reviewing deals and opportunities, looking at underwriting, managing your property, communicating with your tenant, communicating with your property management company about what they're doing with your tenant. So that's part one. Generally speaking, especially in the years that we're buying properties, that's not a hard number to hit, in the sense that, you're going to be looking, Justin and his team are going to give you, 10, 20, 30, 40 deals to look at potentially. And, some you'll go more in depth, some right off the bat, you might say no. But even, as you get into a transaction, there's probably 50 to 100 hours in the transaction where you're on calls, asking questions about the tenant, signing documents, learning more about the deal from our team, asking questions. So that's part A. Part B is it has to generate the majority of your income. And so if you're retired or your spouse does not work, that tends to be a good opportunity, because then they could be the real estate professional. If you and your spouse, let's say, own the property 50-50, you're both getting K1s from the property. And therefore they are majority of their income, because they don't have income other places, is coming from the real estate. And then you have to be actively involved and is the third part. So it's not just the 750 hours, but it's actively involved in the property. It can't just be fully handed off to um, pure management. And so that's easy, because you'll work with your property management company, you'll work on the acquisition. So those are kind of the three key portions of it.
The nice part about opportunity zones and some of the nuance in the requirements is that it creates the opportunity for somebody to hit that last point pretty easily. The nature of the leases, you can't have triple net. Owners got to have some form of job creation and management, active management in the property. And that can be very minimal or very extensive. But for those looking for ease, you can be both minimal management and actively managing the property at the same time. Jason, why don't you talk a little bit about the lease structures typically in these opportunity zone transactions? How much is involved from a management standpoint for an owner, or how easy are they to own and operate if this is something new for you?
Sure. So you can't have a triple net lease in an opportunity zone. Now, Justin, you and I have spent extensive amount of time talking about across the country. The definition of triple net, it varies which is probably more frustrating to you as a broker when you guys get an OM before you see a lease and it says triple net lease, and then you get the lease and it shows a bunch of landlord obligations. But for the most part, you're not allowed to have net leases or triple net lease opportunities in an opportunity zone, because the point of opportunity zones was job creation, not just in the building development or rehabilitation of the property, but also in the ongoing operations of the property. And so we often will modify what is normally a triple net lease into some form of what we call a modified double net lease to give the landlords some responsibility just to meet the OZ requirements. And in those situations, we have a few that we like to choose from. Justin and I each have our own personal favorite. And it just depends too, which one you want to pick or which one the tenant's open to. No tenant has ever said, please take responsibility off my plate. So far, we are batting 1,000 on tenants willing to give up responsibilities at no additional rent to themselves. But you can do anything from securing the, common area landscaping and maintenance. So there's people to come in, clean up the trash if there's trash in the common areas, so they can drive through outside of the building and do any landscaping like mow the lawn or rake the rocks if we're in Arizona, make sure that there's water getting to the grass. Another option that we talk about often is roof repair and replacement. The properties we tend to look at for clients are brand new construction. So the roofs tend to have anywhere between the 20 and 30-year warranty. And, you have to coordinate the annual inspections and any repairs and maintenance. But at the end of the day, it's also something that's not a big out of pocket cost for you to have to pay for.
Yeah, and for those asking or wondering what is a triple net lease, triple net means the tenant pays the property taxes, the tenant pays the insurance, and the tenant pays the repairs and maintenance. So basically, all of the operational expenses related to running the property are taken care of by the tenant. Or, as Jason mentioned, you can't have a triple net lease, but you can have a double net lease, and you can have a double net lease where you hire a property management company, and they make sure that somebody's job is every 6 months to go provide you a one-page report on the status of the roof. Or, as Jason said, I think his new favorite one is when we have a property in the Southwest that the owner is responsible for the landscaping, which he likes to refer to as raking the rocks. There's various levels. We have some clients who like to pay the taxes because they want to make sure that they get paid and they don't have any penalties, and then the tenant reimburses. But all of those things can be items that happen once, twice, maybe four times a year that somebody's got to actively make sure that it's getting done and that it happens. So the management of these properties, you don't need to have a ton of experience on making repairs. You don't need a ton of experience on finding the right insurance for the tenant, because the tenant, as a national brand, has an insurance provider that they work for across all of their sites. So that can be very simple in the job creation, but effectively meet the requirements and help people have jobs in the communities that the opportunity zones are trying to benefit. Jason, talk last thing before we get out of here today. Talk about security of these investments related. Maybe compare it to what you see across the board with all the different real estate clients you look at, because I think one of the things that makes our golden opportunity zone strategy special is that it's really built on capital preservation for people that have worked hard in their business life to create wealth and opportunity for themselves and not lose it, but to be able to maintain that wealth and create cash flow and get some of these tax benefits so they can reinvest and grow a larger portfolio for their heirs. So, talk a little bit about the security of these leases.
So that's, I think, the biggest part about the strategy that you guys work with your clients on is you focus on highly stable, high credit, generally publicly traded companies as the tenants at these properties. We're not chasing an extra 1% annualized return and going into a riskier location with a, little to unknown tenant or a franchisee with, three or four, locations. For this strategy, as you said, Justin, you've worked hard, you've earned the money. The point now is what I like to refer to as mailbox money. No matter where you are at, auto deposit money. It used to be called mailbox money when people sent checks, but I think now it's auto deposit and ACH money. But every month, usually on the first, or as we found with most of these large national tenants, 2 or 3 days before the first. So like my guess is most of our clients will get their payment Monday for July, which is the 29th of the June. The money shows up in the bank and you could be traveling in Antarctica or at your home and the money still gets there. And the goal is where your property should not go down in value. The tenant will continue to pay rent and there'll be rent growth. But at the same time, you're getting a nice stabilized cash flow. Going back to the beginning of this discussion, it is the bonds of your portfolio. It is not the VC fund that you're investing in. It's not the high growth strategy, Merrill Lynch product that you're going to. It is your bonds, the most stable base foundation of your portfolio. But you know that at the end of the day, you're going to get X amount of dollars every single month from a large credit tenant, let's say Starbucks, CVS, Caliber Collision, 7-Eleven, Chipotle, they go on, that is going to pay rent. And we've even had, I think, only one situation out of maybe 100 where we bought the deal and the tenant decided that they didn't want to continue the operations at the property. But we're 7 months in and we're in the process of hopefully right now securing a new tenant. And that tenant has still paid. It's Starbucks. They paid every single month on time in full. They just chose not to be open, but they're still paying their rent. And what we're actually going to hopefully be able to do in that situation is bring in another really good tenant into the space and negotiate a lease buyout, which will put money into our client's pocket to do any TIs plus extra, right? Carry the 3 months of free rent plus that and go with the TIs, pay for the TIs and have extra money at the end. So it's actually going to probably turn out to be a win for that client. But again, the rent, I guess my main point is the rent's completely been paid, even though they're not operating at the property.
Great locations are always a win, and that's the fun part about finding these in opportunity zones is that there are great locations. One of the things I think that's been really enjoyable, for 2 people that really like real estate is that the opportunity zone tran many of the opportunity zone transactions we've done together have been with people who didn't own a lot of investment real estate or any real estate purely for investment purposes before they got into one of these OZ transactions. And our investors that have done it, they love having the cash flow, as Jason mentioned, on the 29th of the month. They like the consistency, the little bit of management that's required is worth the income. And then I think one of the really cool parts is that whether it's kids or grandkids, in a lot of cases, they've got somebody that really likes Chipotle or that goes to Starbucks all the time. And to be able to own a piece of one of these national brands that are so well respected as a part of their retirement portfolio, in addition to all the tax benefits and the cash flow benefits and all the things that we've talked about, it's really that combination of being able to own a piece of these great brands and have it be a really fantastic investment that makes these golden opportunity zone transactions a really great piece for anybody who's had a capital gain event, not just for the long term real estate professional. Thanks for joining us today, Jason.
Thanks for having me.